All right, hello, and welcome to Camel Finance. I'm your boy Camel, and as of yesterday, we saw some significant changes. I've been saying for a while things can change and they can change quickly, but they haven't changed yet. However, I think as of yesterday, we finally have our answer. The market has spoken, so I want to go through the importance of managing risk here, of knowing when to be in the market and hyper aggressive like I have been all year up until now. And now is the time to be neutral. Now is the time to sit on the sidelines for at least a couple of weeks, in my opinion, and let the market setups play out. We want to let the charts paint nice entries for us so we can have high probability setups. We need to be mindful of where the cycles are and what the cycles are telling us, because as of yesterday, they have told us we've got failed cycles. They've told us we're going to have to wait at least a couple of weeks before nice setups are going to turn up again for us. And the thing to do here is to say, okay, we had a really good start to the year. We locked in a lot of profit in January and February. We've since given back a little bit. However, we're still in profit. So the thing to do is not to overtrade. We don't want to be overtrading. We don't want to be scrambling to get in and out of the markets and doing all of this stuff. We just want to take it one day at a time. We know that the cycles have failed now. There is one glimmer of hope left, and that is that CPI comes in on a 5 handle next week. If we get a 5 point something for CPI, then I could see a situation where the markets quickly reverse, quickly recover their levels and go on a bull run. However, that is not what the cycles are telling us to expect. So I'm going to show you all of this. Jordan said the legacy markets were bleeding yesterday, and it's not about traditional banks blowing up, which is what's all over Twitter. It's also not really about crypto, such as the Silvergate collapse. That stuff has been known to the market for a while. Instead, it's likely either a leak of strong payrolls number tomorrow, which of course at the time of recording is due today, or it could be a well-designed trap to be sprung today. So we'll see what happens. As ever, we take it one day at a time. We have no bias. We're completely flexible. Data is the data. Okay, as of yesterday, we were looking to make a 34-day streak for the S&P 500 closing above its 200-day moving average. Remember, no prior S&P 500 bear market in history has ever made a new low after making 18 consecutive closes above its 200-day moving average. But as of yesterday, the mama was broken, the mother of all moving averages being the 200-day moving average. The S&P 500 is now below that. For context, what this means is we can expect the October lows to hold. However, in the short term, closing below the 200-day moving average is likely going to lead to further downside. I had people telling me that I was crazy for making yesterday's video where I was saying I think the market is prematurely priced in a 50 basis point hike, but we're right back to 50-50. Okay, we're right back to 50-50. I still think a 25 basis point is most likely. However, if we do get a hot CPI print on Tuesday, then the likelihood of seeing a 50 basis point hike becomes much more viable, in my opinion. I'm still rather surprised there is so much angst and panic and debate over these interest rate hikes that are clearly coming to an end, regardless of whether there's another 50 or 100 basis points total needed to finish off this Fed hiking policy. The majority of these hikes are now behind us. And this is absolutely right. We have seen the worst of these hikes. Even if we go another 100, 150 basis points, I mean, this is not going to go on forever, is it? Not to mention we're starting to see other central banks around the world pause rate hikes already. Trueflation has their prediction for CPI on Tuesday at 4.78. Admittedly, I think this is far too low. I do think we could get it on a 5 handle. However, it's also possible that we see it elevated above the 6.4. And the reason I say that is because they did recently change the way it's calculated again. And whenever they do that, that always sets off alarm bells in my head. So we'll see what it says. The M2 expansion, as I showed yesterday, has turned negative on a year-over-year basis. That tells us to expect a sharp drop and sharp decline in the CPI readout. And also shelter, which makes up around 40% of the basket and is a lagging indicator of inflation, has still not really shown up in the CPI basket. So when that does, we can start to expect CPI to come off very, very quickly. We get to find out on Tuesday, of course. So just before we get into the charts, I wanted to point this out. Look, March is and always has been the month to do nothing. Instead, most are just giving back all their January and February profits by overtrading. And so this ties in nicely to what I was saying at the start. We had a really, really good year. We had a really, really good start to the year. We will have had to pay some stops, and I'll show you all those, of course, because I am the only real trader on YouTube. I'm the only one that shows you all of my positions ahead of time, win, lose, draw. I also call out all of my mistakes and show you anything that I do wrong whatsoever. So I have had to pay some stops as of yesterday, but because of my hedges, because of the great start to the year, it's not really a big deal. So I'm going to show you this now. The dollar still behaving as expected, isn't it? We still kind of expect to see this waddle up to here and then look to break down. So will that happen or won't it? That remains to be seen. The yields appear to be not believing we're going to see a 50 basis point hike. And they also appear to be thinking the same as me, which is we are closer to the end of this rate hiking cycle than the start of it. So we have clear breakdown, retest, looking for that resumption below that low right there. So happy days, the 10-year coming off. And this is the chart of truth, remember. We call the 10-year yield the chart of truth. Look at the 2-year yield. Breakdown, okay? So early warning signs for seeing the end of this rate hiking cycle, and for me being correct in yesterday's video when I was saying about the 25 basis point hike is still more likely than the 50. Of course, as I keep saying, CPI dependent. That will be CPI dependent. So I want to hop into the gold chart and I want to point out a few things, okay? First of all, we did really well at a good start to the year, getting in here, flipping short here, and then getting long again, live on the channel before getting out on this big breakdown right here. Since then, sitting on the sidelines and not doing anything has been the best decision possible. So I'm still looking to see this gold trade roll over, this gold price roll over, and then get a breakout somewhere down on a 1700s handle. And I think that becomes a massive, massive, massive opportunity to get long the metals. So big opportunity coming up for people that are able to do nothing in the meantime. Again, this is going to be a recurring theme, I think. Don't overtrade. The same is kind of true of silver. I could likely see us adjusting this trend line. I could likely see us perhaps even getting a slightly steeper angle and setting a trend line a bit steeper before having one final dive down for silver and a breakout, and we could go long at the end of this month. Again, sets up massive, massive opportunity for those that are able to sit on the sides and do nothing. The same is true of the miners. I think we could draw this trend line here, and when gold breaks out, I think we could add exposure via the miners on a trend line break here. And the same is true of the junior miners. So at least in gold, I see opportunity, again, coming to those capable of sitting on the sides and doing nothing. Natural gas, possible trade here or possible breakdown of this box. We'll see which way it goes. Either that or we'll get a breakout above the top and then look to long that. So there is possibly some opportunity here for natural gas. For now, again, patience will be rewarded. So hopping into Bitcoin. Okay, there's no denying we now have a failed cycle. Now, I don't know exactly whether we've got a 57-day cycle low or a day 63 cycle low, but either way, we have closed below that cycle low now on a closing basis. There is always the chance that this forms a V-shaped recovery and that turns out to be just a stop run. But the way I see it is we have a failed cycle, and I've been saying consistently that if we were to fail, if we were to get one of these failed cycles, then we would likely be expecting a declining cycle into the next 60-day cycle low due at the end of April. So as it stands, unless we can break out of this downward sloping red resistance line, that is my primary expectation. So this first trade stopped out for a profit. That was what moving the stop up was for in the first place to this level here. So first trade locked in, really happy with that. Big, big profit capturing this move off the lows. If I click this chart onto log, you can see this purple dashed line is the logarithmic bear market breakout. If I extend this out a little bit further, so you can see, possible that we're going to retest this before moving higher. It'll be really interesting to see if this level holds. There is another scenario in which if we get a low CPI print and risk rallies, then you'd likely expect to see something like this and a breakout, a repair of this downward sloping red resistance line. So if we do that, I will be more than happy to add along on a breakout of this and see what the market can give. It's highly unusual for Bitcoin to fail this early in its 60-day cycle and not have a pop-up at some point. So I wouldn't be surprised to see that. But again, as I've been saying, things can change and they can change quickly. As of yesterday, they changed quite quickly. My primary expectation now is that we at least have to have a consolidation cycle into this next 60-day cycle low before we can go. And things could certainly get ugly here. So again, there will be a big opportunity. Just like this was a big opportunity to capture on a break above this, which of course most people missed. There will be another big opportunity somewhere in this neighborhood. The thing to do right now, in my opinion, is to wait for a breakout above this or to wait for that next 60-day cycle low and then go. So Ethereum, same sort of deal, isn't it? We are stopped out for a little bit of profit, but there's nothing we could do about that. We were looking to ride this trend, looking to see how strong this uptrend could be, and it just wasn't that strong. So nothing more to say about that really. As with Bitcoin, I think if we can find that cycle low at the end of April, then we have a good chance of coming out of there, or a trend line break of this could be an indicator and a signal to attack. In the meantime, I think it's time to get back to sitting on the sidelines from a position of power and conserving profits. XRP, I wonder how many people got trapped on this little breakout. And this is why I wanted to use the red horizontal line. So get above there and I'll still be happy to long this. I keep seeing like rumors of the Ripple versus SEC case coming to a settlement. So of course that would drive price higher, assuming it was a positive resolution. But for me, until we get above this red line, I am not interested whatsoever. MATIC, look, we took the profit on MATIC and since then it's just continued to fall and fall and fall. So again, more profit locked in, more sitting on the sidelines. I think we can get rid of this and say if MATIC breaks out of this downward sloping red resistance line, then that's a long from me all day long. But if it's going to continue to bleed down, which I suspect it might, then I don't want to be anywhere near this. I don't want to be over trading. I want to continue to be patient and come from a position of power. Over in the stock market, beautiful secondary retest of this bear market resistance line from 2022 in blue here. So might have to pay a stop on this, more than happy to. And the reason for that is, of course, all this equity exposure was hedged. Look at the hedge finally performing. I continuously have been saying not really spiking, not speaking to a volatility event. Well, now it finally is. This is why I was so comfortable in holding my positions, because I knew that even if I had to get stopped out on the equity longs, this would cover those stops. So even in the worst case scenario, my portfolio, my trading positioning was hedged. I'm not going to suffer any losses here, and we are still significantly in profit for the year. Nasdaq likely going to get stopped today. That's absolutely fine. We're going to have to go back to a stance where we are looking to buy a breakout of this green resistance line. So we've gone back to a simple approach. We're still well above this red downward sloping bear market resistance line, as you can see. There's a good chance we just chop around here for a while and then come out of this. We'll have to wait and see how this goes. But again, it's time to hop out of these positions. It's time to sit on the sides from a position of power and not overtrade now, and come to the realization that it might be weeks to a month and a half before I re-enter these longs. We might have to do something all the way like this and then get a breakout, and I don't end up taking a long. My next long might not come till the summer, but that's okay because this is how it's done. We're not overtrading. We're not forcing anything. We're waiting for the setups to come to us and making sure we stay on the right side. Dow Jones position officially stopped, so can't say I'm surprised given the recent market volatility. Looks to be wanting to come in for a retest of this bear market resistance line again. So will these retests hold? Remember, as long as they can hold, then it's still a bullish setup. It's only if we start to close back inside this that we can entertain new lows. The data at the moment doesn't point to new lows, but of course that could change. The Russell 2K seems to be leading this move to the downside. So are we going to end up just seeing some big basing structure where we come down to here, perhaps, maybe still form a higher low or an equal low, as long as we don't take out these lows here and here, and this is the same for all of these US equity markets, there's not too much to get concerned about. Similarly, sitting on the side from a position of power waiting to attack as we get a breakout of this blue downward sloping resistance line is going to be the best strategy for the next few weeks. So that might well mean sitting here and doing absolutely nothing. FTSE 100, this is why it's important to respect risk. This is why it's important to know when to be in and out of the markets. So this is certainly going to be the attack point, this downward sloping red line. Let's color this a different color. So get back above that and we can have a long here, targets the top of this. But again, I would not be surprised now if we have to spend significant amount of time underneath this before we can actually get an actionable trade out of the UK 100. Coinbase is likely to be stopped out today, so that's okay. Again, we let the first profit finance the secondary trades risk. So no harm there really. We'll see how this goes. MicroStrategy, because of Bitcoin's failed cycle, I'm not going to let this go into negative. I'm going to try to cut this as close to break even as the market will let me today, and then sit on the sidelines and wait for a breakout of this. So get a breakout of this downward sloping red resistance line, or perhaps out of Bitcoin's cycle low, and you will see me go long again, MicroStrategy. But for now, it's about, again, locking in profit. It's about making sure we stay on the right side of the market. If the market changes, if the market tells us this isn't going to get considerably worse, then we can always add this exposure back. The same is true of Marathon. I might as well cut this trade and get back in on a break of this downward sloping purple resistance line, right? First available opportunity to cut this trade near break even, we will, and then we will look to just re-enter this trade when it's safe to, once the market has told us it is ready to change structure. As always, of course, there is nothing to say this isn't going to considerably roll over and stay in a downtrend for some significant amount of time. Riot looks like it's going to be stopped out today, and we're going to end up walking away with a little bit of profit on this trade. So that is what it is. Again, even if it's not stopped out, I don't want to be anywhere near longs for Riot given Bitcoin's price action. So we can get rid of all of these. We can draw this trend line out to here, and we can move this to here. And this is our next angle of attack. We'll see if we can get down there. But again, there's nothing to say that we're not going to just bleed for a full 60-day cycle for Bitcoin into the end of April before we can go. So I don't want to be anywhere near these trades at the moment. I'm going to keep my hedge, of course, because my hedge will pay for all of the stops. The trades earlier in the year, like the Nasdaq and like the metal markets, and like capturing this move on Tesla, has enabled me to sit back quite comfortably now. I don't really have to do anything. I don't want to force anything. I've made good profit so far. And like I keep saying over and over again, it's all about just knowing when to be in the market and when to be out of the market. There's going to be massive, massive, massive opportunity coming up for those that are able to sit on their hands and do nothing. But when we look at this melt up chart, it's currently difficult for me to say that this is super valid. It's currently difficult to say that this isn't likely to be invalidated. It was right until it was wrong, okay? But as it stands right now, if we close back inside of here, then we're likely not going to be melting up. Instead, we're likely going to form a bigger bottoming formation like this double head and shoulders. And then we're just going to be into normal sort of market price action, no blow off top move. So I'll be open to changing my stance if the market proves that to me. If CPI comes out really low next week and we do something like this and then break out on FOMC, then of course this continues to be valid and I can reposition myself according to what the market is telling me. But as of right now, this is not a very nice look in my opinion. This is continued weakness. So especially if we take out this set of lows back here, I don't see any argument for saying that we're going to have the blow off top like I expected. It could still happen if we have the lower CPI and a 25 basis point hike and the Fed moves to a pause, but that's not what they're telling us they're going to do at the moment. It's also not what the chart believes is going to happen, or we would have seen more strength out of here. So as ever, we'll take it one day at a time. Massive, massive, massive opportunities coming up, as I've shown you, as I'm sure you're probably aware, given all the TA, but it is important to sit on the sides now and wait for the market trades and setups to come to us. I'm your boy Camel. I hope you're doing well in life. I hope you enjoy your Friday. Take care from me in the meantime. All the best. Cheers. Bye.